Good evening. Thank you for joining tonight's Corporate Connect. This evening, we are pleased to have ESR Logos REIT, as well as our audience from Facebook Live. This webinar is organized by SIAS and supported by XGX. We will kick off tonight's webinar with a presentation by Mr. Jeff Howie, market strategist from SGX on recent market highlights, followed by the corporate presentation by Mr. Adrian Tree, Chief Executive Officer and Executive Director of the manager, ESR Logos REIT, and we will end off with a Q&A session. But I guess ESR Logos is no stranger to us. I think remember last year in 2022, SIAS facilitated a few pre-merger sessions with the unit holders, and now post-merger, the enlarged REIT, now known as ESR Logos REIT, is the leading new economy and future-ready Asia Pacific S-REIT. Listed on the Singapore Exchange Securities Trading Limited since 25th July 2006, ESR Logos REIT invests in quality income-producing industrial properties in key gateway markets. With a total assets of approximately 5.7 billion, comprising 82 properties across Singapore, Australia, and Japan, with a total gross floor area of approximately 2.3 square meters. I think we will hear from Adrian tonight on the company's latest business update post their FY22 results. But before this, let's invite Mr. Jeff Howie to kick off tonight's session. Over to you, Jeff.
Hi, thank you very much, Eileen. Give me a second while I share the screen. And good to go. Thank you, ladies and gentlemen. I'll just take a quick 15 minutes or so just to remind you the material is educational and we're not providing financial advice this evening. And we are focusing on our S-REIT sector, in particular ESR Logos REIT. For our sector, the sector has continued in early 2023 to attract more than its fair share of investor activity. This sector at the end of January represented 12% of the total market capitalization of all the stocks listed on Singapore Exchange, but at the same time represented 21% of the day-to-day turnover of the Singapore stock market. And that, I guess, 12%, 21% contributions, it's really high when you look at it from a global perspective, because going into this year, it was something like $2 trillion of market value was represented by the entire global REIT market. So that's around 2% of the global stock market. REITs have been listed in the US since the 1960s. And while they make up something like a quarter of the 800 or so REITs listed across the world, they do make up 60 to 70% of the total market value of all REITs and the big benchmarks set by FTSE EPRA NAREIT. And thus, the US REITs and the relevant drivers of the US REITs do have a significant impact on the overall tide of, I guess, fundamental and valuations of the global REIT market. In Singapore, as many as 17 of the trusts exclusively invest in properties outside of Singapore, with 20 of the trusts investing in properties in both Singapore and outside of Singapore. And then we have a remaining 3 REITs that are investing exclusively in Singapore. It includes, as many as 14 of the trusts have properties in Australia, of which ESR Logos REIT is one of those trusts. And I think Adrian can correct me when he comes on, but it should be 20 properties, industrial properties in Australia, of which 10 are based in my home state of Brisbane, or my home city of Brisbane, around the greater Brisbane area. But for the broader S-REIT sector, 80% of the trusts own or manage overseas assets from across pretty much the Asia Pacific, the United States, and Europe. And S-REITs are now one of the most international REIT markets across the world. Of the 8 or so industrial REITs, there's just the one REIT which is exclusively listed with Singapore properties. And that's understandable given the role that the global trade plays in warehouses, depots, and logistics centers and so forth. So the trusts are also very highly diversified across property types, with a nice balance across retail, industrial, office, and hospitality properties, in addition to, I guess, now multiple REITs that are investing in healthcare-related properties, as well as specialized REITs such as data centers. As of the end of January, the average distribution yield of the listed REITs and property trust, it stood at 7.2%. That's still a ways away from the STI yield of 4% at the end of January, and the MAS's benchmark 10-year bond yield, which was 3% at the end of January, and current core inflation is around 5.1%. And I guess despite the backdrop of increasing rates, where the Singapore 10-year bond yields had increased for much of last year, the FTSE ST REIT 12-month forward dividend index is still offering a higher spread of around 270 basis points thereabouts. In terms of the debt levels for the sector, it maintains average gearing ratio, which is obviously total debt divided by total assets, of around 37%. And that's lower than the regulatory limit of 50%. And for the REITs and trusts, a lower gearing ratio can obviously indicate a greater capacity to undertake more debt when needed for future acquisitions, while a higher gearing ratio could lead to credit concerns, especially obviously during economic downturns. The sector has also, as we reported last year, averaged, or I guess secured on average 75% of their borrowings on fixed rates. And despite the challenges of the past 3 years, which have included lockdowns, the more recent higher interest rates, currency volatility, and higher energy costs, S-REITs have taken a proactive role in their capital management to increase unit holder value by divesting, recycling, acquiring properties, or in some case, merging REITs. And our first merger in the REIT market was back in 2018. And I know Adrian was involved in that. So the audience, you might want to ask him a question or two on that, which was a good 5 years ago when it was completed. But I guess portfolio acquisitions have been really in the spotlight in the recent couple of years. They can be funded not just through debt, but through secondary fundraising, such as placements or rights issues. And we saw just over half of the S-REITs listed on SGX announced asset acquisitions valued at more than 20 billion Sing dollars in total purchase consideration over the past 2 years of 2021 and 2022. So going into where we are now, in January, we saw expectations for the US Fed Reserve at last week's FOMC. The expectations for that meeting that was taking place last week, they really did anchor to a 25 basis point hike rather than a 50 basis point hike. And that saw 10-year US Treasury yields decline from just near 3.9% to 3.5% in January, while the US dollar to the Sing dollar also depreciated from around 134 at the end of last year to around 131 at the end of January. And what this did is see the S-REIT sector outpace the STI in the month of January. So within the STI, Keppel DC REIT was the stock that actually led the entire index in the month of January, after it ranked among the 3 biggest decliners in 2022 and 2021. And of course was among the 2 strongest gainers back in 2020. Mapletree Pan Asia Commercial Trust, Fraser Logistics and Commercial Trust, Mapletree Logistics Trust, and Mapletree Industrial Trust also ranked among the 7 strongest STI constituents for the month of January. So Keppel DC REIT reported back on 31st of January that its full year FY22 results, its distributable income grew 8% from FY21. And it maintained that it was continuing its pursuit of data center growth and was also obviously applying its disciplined capital management approach. So in 2022, Keppel DC REIT was among the 18 REITs for that year that did announce acquisitions, and it expanded its presence in London and also in Guangdong, which is one of China's most established data center markets. So what else is going on? As the internet and the semiconductor industries really led the global stock market in January, in Singapore, our technology sector also booked the most net fund inflows for the month. And that's after they saw among the most net fund outflows last year. In fact, for much of the year, they did rank among the stocks that saw the most net fund outflows. The close to 40 traded stocks of Singapore's technology sector booked close to 60 million in net. Sorry, it booked close to 50 million in net fund inflows for January, with the first week of February extending that up to 60 million Sing dollars. The fund inflows have been led by inflows into SDI Constituent Venture Corp, UMS Holdings, Franken Group, and ISDN Holdings. And also we've seen in the ETF market, the Lion OCBC Securities Hang Seng Tech ETF rank among our most traded listed SGX listed ETFs in January. And the iShares Asia Yield Bond ETF, which has a 54% country allocation to China, Macau, and Hong Kong, that recorded also close to 60 million Sing dollars in net inflows for the month of January, following something like 150 million fund outflows for the fourth quarter of last year. So I guess when we look at our 100 most traded stocks for the month of January, 8 of those actually represent the tech sector, and they averaged around 11% total returns in January, which was a partial turnaround from their average 36% declines in total return last year. With that 70% revenue exposure to China back in 2021, as we discussed last week, ISDN Holdings has led the performance of those 8 tech stocks with a close to 40% total return in January. But I guess throughout 2022, the global stock market, it was determinedly forward-looking. The global supply chain and subsequent growth concerns really did weigh global technology stocks. And as we discussed before, the energy costs, the rising interest rates, currency volatility, and subsequent growth concerns also weighed global REITs last year. And those 2 sectors, technology and S-REITs, ranked among the least performing global stock sectors for much of the 2022 year. So not just in Singapore, but across the world. And I mean, the dampening of economic expectations actually saw the FTSE ST REIT index price to book ratio declined to 0.84 times at the end of October, or a 16% discount to book value in October. And then what we saw is China's ensuing, I guess, economically supportive, business-friendly policies, and combined with a little bit of economic strength in Europe, as well as the marginally less US rate outlook, or less hawkish, I should say, marginally less hawkish US rate outlook. Those 3 factors had helped to see the FTSE ST REIT index discount to book value narrow to something like, as we said, discount of 16% at the end of October to a discount of 5% at the end of January. And that is still significantly shy of the index's 18% premium that we saw back in January 2021. So looking ahead, I guess what the IMF has stated just within a couple of weeks, I think it was the 31st of January here in Singapore, they estimated global growth this year would decelerate to 2.9%, then pick up to 3.1% next year. Both global rates for 2022 and 2023 in their outlook were slightly upwardly revised by 0.2%, and that was on greater than expected resilience in Europe in 2022 and the outlook for emerging and developing economies. However, weighed by dampening global demand, global trade volume projections were revised slightly downwards to 2.4% this year, and then to 3.4% next year. And the average oil prices also are expected to trim or decline by 16% this year. But at the same time, while oil prices coming down 16%, global inflation was revised slightly upwards to a 6.6 projection this year for global inflation, very much in line with the projection for Singapore inflation, and still well above pre-pandemic levels, which is around 3.5%, but still below last year's 8.8%. So for the trade-weighted economy, or trade-centered economy, I should say, that Singapore maintains, the growth, the trade, and the inflation projections for Singapore this year are very much in line with global expectations. And the week-to-week growth outlook, it does still remain very fluid, particularly from the perspective of China and the US developments. So that gives us this dynamic, fast-moving market driven by both global demand and supply factors, such as you said, these growth outlooks, prices of energy and food, wage pressures from tight labour markets, and of course, a lot of other supply chain constraints as well. So as we've always said, as much as 60% of Singapore's economy, it is comprised of manufacturing, wholesale trade, finance and insurance, as well as information communications and technology. And they were positively impacted in 2021 by the global rebound. And just as the same measure, they will be expected to be impacted by the decline in global growth that is expected, or the declining rate in global growth that is expected this year. But from now, much of the focus is on how the more regional resilience might be able to offset this. So we are right in the thick of it at the moment, with 400 of the Singapore listed stocks that are reporting their FY results this earnings seasons. And the real particular focus, of course, is on how the decelerating growth may be impacting revenue in the months ahead, and also how much persistent inflation can be weighing the operational costs of the stocks. So that was just a quick summary. If you'd like more information, of course, the QR code is there. It was there to join our Telegram. But I just wanted to give a very quick overview of the REITs. The sectors that are on the move this season. Obviously, we've seen big mean reversion just in January alone in the technology sector following the 2022 underperformance. And we've also seen REITs as well see some mean reversion as well. And I'm going to finish now and let Adrian take over. So thank you very much again, and we look forward to seeing you again soon.
Hi, thanks, Jeff. I appreciate it. Thanks everyone for joining this webinar. I'll just run you through. We obviously announced our results this year, this on 30th of January, and we are now talking to investors, giving them an update what they've done in 2022 itself. So I shall go through a quick slide on the what we're going to go through today is basically a quick slide of the results that we have for 2022, and then after that give a bit of granular details of what we're going to do in terms of what we're going to do in 2023 as well as 2024. If you look at our the next slide, which is the our key highlights. Our DPU for this year is 3 cents. As you are aware, 2022 we completed the merger with ALOG in April. So the second half of 2022 results was actually a full half year of results with regards to the contributions from the combined and large entity. So when you look at the distributions of second half 2022, which is a full merger month itself, full merger half a year versus the second half year on year of 2021, the DPU is up 7.5%. NAV is at 36.4, and total assets after the merger is about 5.7 billion. In terms of our operations matrix, we have a very strong positive rental revergence of 11.8% versus FY21, where it was minus 1.7%. Our rental revergence is actually very broad-based. If you look at my results itself, you would see that we have 4 sub-segments in terms of our properties. Logistics as well as the high-specs industrial are the one that were leading this positive rental revergence, strong positive rental revergence contribution, primarily from the logistics sector where it was 15.7% positive rental reversion, and the high-specs sector is about 12.3%. The general industrial building, which are the older dated assets, are not also doing fairly okay. It's about 9.8% rental reversion, with the business parks coming about 4.8%. I think this is it's no surprise that we are seeing these results because our 2/3 of our portfolio is exposed to what we call the new economy segments of logistics and high specs. And these are the ones that is exposed to currently the strong economic trends that is changing post-COVID, especially in the way goods are produced, consumed, as well as delivered. So that is when we expect the positive rental revergence to go into 2023 still in the 2 sectors of logistics as well as a high specs, although the pace and the depth of the rental reversion size of double digit probably be tempered down. As Jeff mentioned, recessions and recession concerns are already hitting us. It's already in Europe, and in US it's probably going to be there, if not already is at the doorstep, if not it's already in recession. So it will temper the base, the expected rental revergence that we have, but we still expect rental revergence in these two particular new economy sectors of logistics and high specs. Is because of the economic trend that's changing. At the same time, for us, our own portfolio assets, our passing rents is still below the market rents that what we are seeing right now today. I don't have it in the slide here, but if you look at my results announcement, you will see that in our slide 14, you will see that the passing rentals of our in-place rentals are still below the current market rents. Why? Because most of the Singapore rentals leases are generally in the region of 2 to 3 years. So which means that the leases are expiring in 2023 are actually entered in 2020, which is actually the COVID years where there is very big impact and big slump. So that is why the rental reversions, we still expect going into 2023 to be still positive, although we don't expect double-digit rental reversions. Now, in terms of occupancy, we dip about 1% lower than last year. Is primarily because we divested assets, as well as we closed down 2 assets to do asset enhancements, 16 Tai Seng, as well as we closed down, redeveloped 221 Senoko Loop. At the same time, 2 other properties are also still undergoing asset enhancements, and this will get these asset enhancements will be ready towards later of the second half of 2023, and going into 2024, then the asset enhancements will be completed. As I mentioned just now, we have a significant exposure to the new economy assets of logistics and high specs. In terms of investment management and investment management, we have divested $150 million worth of assets at an average premium of 15% above book. At the same time, we redeploy some of these assets into another distribution or logistics center called ESR Sakura in Tokyo. We completed that in October. And as I mentioned earlier, we still have one AEI completed in 2022, 2 are undergoing in progress, and 1 new redevelopment is being done, which is 24 on Senoko Loop. In terms of our capital management, gearing is about 41.8%. Our hedges has gone up. If you look at the business update in September 2022, apologies. The fixed rate hedge was about 66%. We managed to hedge more as our old hedges drops off. We were able to hedge more, but more importantly, we were able to hedge it at a much cheaper rate than what we were able to, what we were guiding the market towards 4Q last year. 4Q last year, we were guiding the market that if we want to maintain that fixed rate hedge of 66% as our old hedges drops off, definitely the new hedges entered will be higher because of higher interest rates. We guided the market that if we maintain a 66% hedge, we will, as we renew the hedges, the cost of that would be probably about 3.8% by 31st December 2022. And then going to 2023 with a 66% fixed rate hedge, the cost will probably be about 4.1%. However, I think the team has managed to time as well as to execute the hedges pretty effectively, such that our as of 31st December 2022, the cost of that is 3.66 instead of 3.8%. And also we were able to hedge more at 72%, and they will flow into 2023. So the guidance of 4.1% cost of 2023 will now be likely going to be about 3.8 or 3.9%. So we managed to save 20 basis points in terms of expected interest rate costs. And in terms of refinancing, we have about $230 million worth of loans that's up for expiring this year. I will not too worried about the refinancing because we have about $320 million worth of committed available undrawn RCF, which we can actually able to draw to repay those loans. So this is not something that we are really concerned about. So this is really a snapshot of what we do in 2022, where we not only do in terms of organic growth, rental revergence in terms of asset management. At the same time, on the expenses side, how we mentioned that the 2 big elephants in the room is always energy costs, as well as inflation impact on cost of operations like cleaning, security contracts and all. For the energy costs, right, 90% of our energy costs, the utilities costs, sorry, will actually be on a pass-through basis as we speak right now. So 90% of it will be passed through to, or we on a pass-through basis that we can recover from a tenant. So basically, how much that we buy from SingPower, we can actually will be sell at the same rate to the vendor. So if to the tenants. So if the rentals energy cost goes up and we're going to pay more, we will basically sell at the same price back. So it will be on a pass-through basis, 90%. The 10% is due to common areas, which we still have to have because we have multi-tenanted assets. We have also raised service charges and towards end October last year by about 15%. So the full impact of the service charges will actually come into to offset any increase in expected operating costs when we renew our security contracts as well as our cleaning contracts, so that service charge allows us to actually offset or manage those expected increase as well. So this is a snapshot of 2020, and obviously I mentioned just now we divested assets. We divested 5 assets, as you see, $150 million assets, and we continue to do our AEIs. In terms of strategy going forward, what we will do for 2023, if we go to the next slide, is that we have been doing this whole thing. I mean, the focus when we did the from 2021 to 2022, we were focusing on the fact that we are looking to rejuvenate our portfolio. Industrial assets are quite different from office and retail. The life cycle of the useful life of industrial assets tends to be, the useful life of office assets and retail assets tends to be 25 to about 30 years, after which you could do a major revamp. Industrial assets, no, your useful life is probably average about 15 years. Why? Because the wear and tear from the usage of the building as well as technology changes makes the building sometimes quite obsolete. So you have to continue to rejuvenate the assets, or else you will not be able to be future ready. Tenants, new tenants who embraces new technology, you'll not be able to have them, especially as technology advances in their manufacturing segment. So we have always been rejuvenating our portfolio through acquisitions, redevelopments, as well as asset enhancements. I think the fact that we have rejuvenated our portfolio and focused our portfolio towards more new economy assets actually shows that we are actually benefiting from the rental upsides that's coming up from the new economy segments. Especially now that 62.8% of our assets are exposed to the logistics as well as high specs, which the rental reversion in 2022 showed, and especially in the second half when we became a larger REIT, the DPU on the second half of 2022 versus 2021. Prior to that, when the new economy sectors was only 41.5%, should resulted in the DPU growth of about 7.5%. At the same time, those assets that we cannot redevelop or has limited AEI asset enhancements opportunity, we are divesting. We divest $150 million of assets last year. Previously in 2021, we divested another about close to $100 million of assets. So total we divested about $250 million the last 2 years, because these assets are smallish. The footprint is very small. Land leases were very short, and when we divest this asset, we will recycle the assets, recycle the proceeds back into new economy assets, which actually allows us to attract tenants that's more future ready. And we did that with, for example, the $150 million of asset that we divested last year that I mentioned earlier. We reinvested the money into a logistics asset in Japan for $160 million. Now, if you look at it, the assets that we divested, the Singapore smallish asset that divested, what we call non-core assets, the underlying land leases were averaging about 30 to 32 years. As the land value gets shorter and shorter, your valuation is going to get smaller and smaller. But if the footprint is too small, you can't redevelop and it does not make economic sense, then you're going to see valuations starting to come down because of the short-term land leases. So by divesting these assets and using the assets to reinvest in a freehold asset, I think that's what our asset rejuvenation is all about. And especially and at the same time, we believe that our sponsor will continue to support us in terms of quality executable assets, especially assets in the logistics sector, which is currently very well sought after by a lot of global investors. And if I go a bit more granular details of how we look at our portfolio rejuvenation, which will continue in. If you look at the next slide, you will actually see that the asset enhancements and redevelopments are being done. As I said, three of the assets are currently, two of the assets are undergoing AEIs. The third one is going redevelopment. 21B Senoko Loop is an example that we can actually redevelop some of these assets. 21B Senoko Loop is an old general industrial building where there's a manufacturing plant on one side and a dormitory on the other side. Now, since COVID, when the government decided to centralize all dormitories, just to make sure that they can get control. Today, dormitories that is attached to general industrial building cannot be leased out on a standalone basis, and because of that, it can become obsolete because half the premises can't be leased out to dormitories on a standalone basis. So what we did was we went to look for the build to suit tenant called NTS Singapore, who is in the advanced manufacturing mechatronics segment. So what they did was that we decided to convert this general industrial building to a high specs building, and then they take a long lease of about 15 years and fixed rental escalation and do a build to suit. It's currently under development and it should be completed by first Q of 2024, and income will start coming in. At the same time, we are also exploring a potential redevelopment. We're under analysis and exploring the feasibility and possibility of a potential redevelopment of an existing logistics asset to redevelop the asset into a cold storage ramp-up facility. We have seen the logistics sector having few new pockets of demand, especially from cold storage facilities, due to the need to ensure food security as well as continued supply chain disruptions that we have seen. So we have not confirmed whether we will do it. We will still under analysis, and if we do it, it will be something that we will announce to the market, because we are still negotiating with the tenants to make sure that the risk and the lease terms and the returns actually make sense. In terms of divestment, we are go to the next slide. In terms of divestments, we have identified up to $450 million of non-core assets to be divested over the next 12 months. We have actually engaged CBRE to look at the potential divestment of this portfolio of assets. We have actually pretty good interest from a number of potential bidders to look at this portfolio. We are engaging with them to provide some limited term financial information for them to actually come back to us with a price. Now, this is not a great Singapore sale. If the price is too huge and they try to lowball us to get a big discount, I do not think that it makes sense for us to sell, and we will still sort of maintain. But if the price is sensible, and we can redeploy these assets into other more longer lease tenure and in economy assets, we will look at it. So capital recycling is part of it. We may or may not get the full $450 million, but estimate we should be able to sell probably about at least $250 to $300 million of these non-core assets over the next 12 months, and then redeploy the proceeds into new economy assets. I think the next one is that part of our rejuvenation of our portfolio is through acquisitions. Our sponsor has a good large amount of new economy assets, primarily logistics assets. Our acquisition criteria is quite simple. If we want to acquire new economy assets that are future ready, that's in demand. Logistics is definitely part of that. If we want to go in the overseas, and it has been scalable markets in developed countries. The problem with Singapore is that the industrial land in Singapore are very short, 20 to 30 years. So you always face a perennial land lease decay issue, whereby the value of a property will start to come down. If people are concerned about HDB land leases dropping to 60 years and then 50 years, industrial assets is even worse. They actually have 20 to 30 years. So this would impact valuation of an NAV of the portfolio, and we have been seeing that. So going overseas and this ability to access the freehold, longer leasehold assets is exactly what we would like to, is one of the acquisition criteria they have. At the same time, real estate is a local game. You need your colleagues, you need the people on the ground to be able to manage the properties, lease out the space and all. So based on this criteria, they're likely focused that if we want to acquire any assets, it will likely be in the footprint countries where our sponsor ESR has, and the focus of developed countries will likely be in the countries of Singapore, Japan, and probably Australia. Australia right now, we are seeing a negative spread between the cap rates of logistics properties against the funding costs. So Australia is probably not something that we will be really looking at over the next 12 months, because until the negative spreads become positive. But in Singapore, it's different. The funding cost is still lower than the cap rates that you can get. So that's what we call the positive spread. So it is something that if we think that is value adding to our portfolio, yeah, we will do it. And if it's not, then we will still continue to do our what we call the business as usual, which is rent out our space to get a positive rental reversion, manage the cost to make sure that it doesn't blows out. Interest costs, well, in that sense, I think we are pretty managed in a sense, because we don't really have much refinancing risk. We have increased our hedges to 72%. So overall, I think this is what for ESR Logos REIT in outlook, and as well as our continued execution of our plans going forward. Yeah. Yes, I think there are some questions. Rather than type, I just probably answer them. Then the first one is David. David says, prior to COVID, DPU was about 4 cents annually, but now the situation is 3 cents. For the past briefing, it was part of the reason was because the pref offer. Is there any chance that the DPU will go back to 4 cents again? Well, I do think it is what we're trying to do. You know, you're going to go back to part of the reasons why the DPU has come down to 3 cents. Also, we have been divesting assets. When you divest assets, you know, you will, when you divest assets, you close down assets, you will drop, you will lose income. And that's why your distributor income will also come back. And also, obviously, at the same year, as you know, last year, the interest costs, I'm not interest costs, sorry, the operations costs, especially energy costs, just shot up an amount. Everybody was affected by that. But what we have is that the primary part of the DPU that's coming down is also a combination that we sold assets, we closed down assets, and that is why we need to get back to 4 cents DPU. I believe we can get back, primarily because when the asset enhancements and redevelops get completed, it will add back to that to the distribution yield that we are talking that we have. The 3 cents, and then at the same time, when we redeploy the proceeds from the sale proceeds to acquire the assets, it should add back to the 3 cents DPU. So that was the first one. Second one is from Mike. Mike, hi Adrian. What are the likely divestment of non-core assets current portfolio? Yes, we as Mike, as I mentioned, if you look at our portfolio, we have 4 segments: logistics, general industrial, business parks, and all. These, what we like to call these non-core assets, are generally assets that has very short land leases, 20, 15 years. As well, either it's very short land leases, or the fact that the footprint is so small, such that we cannot, doesn't make sense for us to redevelop, because there's not much GFA that we can add to, and the scale is not enough for us to make economies of scale. I'll give you an example, Mike. I have assets, 64 assets in my property, 64 assets in Singapore. It ranged from $7 million all the way to $300 million. And if you look at the non-core asset that we're divesting in the past 2 years, generally is in the region of the $20 to $40 million. These are the ones that I cannot upgrade. I cannot, there's no chance that I can do asset enhancements to make it sensible. Right? That is why I am divesting those assets out. Okay, so Mike, I hope that is probably that we reply to you. Logistics assets are doing well. Hold on, are doing well. Why were the 2 logistics assets? As I said, it was small, Alex. It was small. The one in Pandan, we don't think we have the price that was given to us. was like a close to 20% premium to valuation. In our view, we can't do anything more on the asset to bring that valuation up to 15%. And if somebody gives me a price that is more than 15% in our view, we can't asset enhance and we can't do anything and it's already marked to market, then the answer is to sell. The Australia asset, even though it's freehold, but it's one asset in somewhere out there that there is no chance for us to redevelop or to try to expand or scale up the footprint. So, and the price that we receive is like 15% premium to valuation. So why not? You know, why not just sell it? Because we don't think that the valuation can go back to that. And also for Australia, cap rates are increasing. So if cap rates increase, generally, you know, you will have an impact on the valuation. So if someone gives us right now the valuation, by the way, Alex, the buyers of these assets are actually the end users. They want to use the asset. So to them, using this asset for their own operations, for their own business, they don't really care what is the underlying land leases, right? Yeah, how do you evaluate our performance of the merger with ARA? Well, if you look at the DPU for the second half, which essentially is where up 7.5% on a year-on-year, second half year-on-year basis. I think it's sort of, and our rental reversion coming from those sectors. I think this is the start of where you see why we go through that angle. And the other thing is also, I think current market price is one. I think there's also, you know, investors of like yourselves always compare current market price, DPU yields. But there's another major parameter, and that is price to book. Like how we mentioned, you know, a lot of REITs were trading at price to book of 0.8 times, you know, and that only recently with the run, they go back to 0.5 times. But our price to book, when those guys were trading at 0.8, was still at premium to NAV. So I think price to book is also a consideration into that. And even though there are some REITs who in the last 3 months or so has ran up, I think how we mentioned some REITs has last 1 month best performance run up by 10 to 15%. But they are still coming up from a 0.5 times book going up to 0.8. They're still below NAV. Whereas for us, our NAV perspective, it is still a premium to NAV, or even if not, it's at NAV. So I think that is where, if you see where the results is coming from in terms of the DPU year-on-year second half, which is more a reflective of a larger entity when the year-on-year up 7.5%. I think this is probably, and the rental revergence is coming very strongly from the two sectors of the logistics segment as well as high specs. I think it is quite encouraging for us in terms of how we can drive the DPU. Will the falling yen affect the best investment return of Sakura Distribution Center? Yeah, in a way, yes and no. What is important is actually the capital value. We funded the Sakura Distribution Center. We acquired the Sakura Distribution Center at about 4.3% cap rate, and we funded the whole transaction at about 1% fixed for 4 years. So we have a spread of 330 basis points, which also means that we will not suffer from capital. Our capital value in terms of Sing dollar terms will not be affected because 100% hedge. Now, at the same time, yes, at the same time, when we entered into the transaction October, the yen was about at 92 to Sing. Yes, today is about slightly 100 or less than 100. But in the short term, but if you look at historically, the yen has always been trading at about 80. So if you look at a longer term basis, I do think that yes, in the short term, maybe the falling yen will affect the distribution, but it will not affect interest rate in Sing dollar terms, but it will not affect the capital value. So in terms of, you don't just lose DPU in terms of Sing dollars, but your capital value in Sing dollars still remains the same. So I guess in the short term, yes, there will be impact. We tend to hedge our returns, our distributions from Japan as well as Australia back to Singapore on a at least for the forward looking of 6 to 12 months. We can't hedge too long because it will cost us a lot of money to hedge too long far into the future. So generally, because we distribute half yearly right now, we tend to at least hedge 6 months in advance of the distribution or 12 months in advance coming at in. The other question is, are you able to do equity acquisition given where your share price? I think the answer is to look at the WACC, not just equity. Usually most people do not fund equity by 100%. fund acquisitions by 100%. There's bit of that, and our WACC is probably still able. Our WACC is probably in a region of 5% to 5%, 5.5%, 5.25%. So any deals, transactions that we believe that's above higher than that, the initial yield may be 5%, but actually with the rental reversions that you see in some of the logistics asset, there is still potential upside as and when as we lease out the new asset. So initial yield, try not to look at the initial yield. Initial may be just initial yield. And the key is actually to look at the underlying passing rent, whether the underlying passing rent is, how does it compare to the market rents. I think the Japan acquisition, we have showed that the passing rents that we acquire is actually probably about, I would say 6 to 7% lower than what the market rentals were. So yes, the answer is yes, we will still be, but it will probably be very selective assets and not whereby you can boom time Charlie and go down and buy everything. Can you share insights on the back office meter? Sorry, I don't really quite understand this question, so I will probably want to skip a little. Can you share insights on the back office meter? What can you expect any effect on TPU? So I don't quite understand this question, so I would probably like to skip a little first. Henley has a question. Can you give some light to the 3 APAC data centers that mentioned in one of your slides? What are the potential in DC? I don't think I have, Henley, I don't think I have any data centers. What I think in my slides, what we are mentioning is that our high specs property are suitable for data center operators to locate, and we have a number of data center operators is located in our high specs building as well as our business park. What are the potential of DC? Yes, DC is the so-called another new economy. We are now on cloud, we are now on video, we are now on streaming. We see that. But the potential is there. But because of that, the price expectations of distribution DCs are also very high. And you would look at DC income yielding DCs reading at 2 to 3% and yield, because people see that, people price that up. For us, we don't really think that we will go and acquire any DCs. Even our WACC will not be able to afford that. So unlikely we will be acquiring DCs. But what we'll do is our high specs properties, we are willing to lease, we are able to lease to data center operators who have the ability and better ability to pay better rentals. So the potential for us in DCs for us is more towards as a tenant in our high spec space rather than for us to acquire DC assets. There was some questions previously from some investors is then will you develop or redevelop some of your assets into data centers? Unfortunately for Singapore right now, there is a moratorium on the amount of DCs, data centers that you can actually do it. This moratorium is still there. And because of that, even if I have the ability to develop, the moratorium does not allow us to develop data centers. What we are able to is those that we have already passed, those have already gotten the approvals for, those data centers, those existing properties that we already have space that is in high specs that are suitable for data center operators, we will actually go for them. Yeah, I think Alex, I sort of answered that question. Are there any plans to add data centers? Currently, the answer is probably no. I think that the returns that is asked by some of the shares, some of the data center operators is, I can't afford it, yeah. But what is rational to change distribution income from quarter to semi-annually? Because of our overseas assets. When you have overseas, you want to repatriate the distributions, you need that, you need to clear tax authorities and all. So and this takes time. So from our perspective, we can't really we can't really get it in time to do quarterly distributions, and that is the reason why we change it to semi-annually. The few AEIs kind of going once complaint 12 months to contribute like roughly how much? Oh, David, I mean, I can't really give forecast in that sense. on that in terms of how much we will contribute roughly in that. Yeah.
Hi, Adrian.
Yes.
Yeah, maybe I just bring on Benjamin Goh, which is our head of research and investor education. I think there are some pre-submitted questions which he might be moderating this session.
Yeah, sure.
Ben,
Sure.
yeah. Over to you.
Good evening, Adrian. Thank you very much for taking the questions.
Yes.
You've made my job a lot easier, actually, because I was supposed to help you moderate. We do have some pre-submitted questions that were handed in prior to the event, but to be honest, I think there's quite a lot of overlap between the questions that were put into the Q&A panel as well as the questions that were pre-submitted. So I'm just gonna go through some of the questions that have not been covered. All right, so we can just start with the high interest rates and monetary policy. So you have mentioned that a fair amount of the debt load has already been hedged at more optimistic rates. So the question here is that, is it easy to divest a Singapore industrial asset in this current high interest rate climate? You've already provided some color regarding your AEI and asset recycling. Perhaps you'll be able to comment on this specific question.
Yeah. I think, look, without a doubt, funding cost has gone up. Okay, so buyers' funding cost has gone up, so the return requirements will probably commensurate with that. Now, I divested $150 million of assets at premium to book this year. I can be honest with you, bulk of the buyers has locked in their funding in the earlier part of the year of 2022 before interest rates goes up. So the assets that I want to divest, that I said that I would divest the non-core asset that we're looking to divest over the next 12 months of up to $450 million. I can be honest with you that you don't expect a 15% premium above book, okay? Because funding cost has gone up. I'm just being realistic about it. But will I divest assets at a huge discount, 20-30%? No, this is not a great Singaporean. These non-core assets, if I leave them there, I will still clip. It doesn't bite me. It doesn't cost me extra money to spend. It's just non-core. It will clip the dividend. You will still do it. But I'm not going to sell this at a huge discount so as to just get rid of it and then impact huge DPU impact and value destructive. But so what I think it will be in current climate environment, you probably get around book or even a slight little discount. If a slight little discount, I can understand. Let's say somebody comes and say, Adrian, look, I want to buy a portfolio. You give me about 8 to 9% discount. Yeah, I may explore it, but I wouldn't need to look at it because I need to look at the terms. Why? Because remember, the portfolio assets that we put out as non-core assets, as I mentioned earlier, they are short-term land leases, 20, 30 years. If you simply just took 1 divided by 30, it means that every year, without doing anything, your value of a property is going to drop by 4 to 5%. That's what we call land lease decay. So if somebody asks you, look, 8 to 9%, will you to sell? And if you take that into consideration that 4 to 5% is already embedded the fact that if you wait and not to sell, the value will drop. Then actually the discount is actually lower than that, right? And if I can sell them with these assets at a slight discount, use their proceeds, bring down my gearing, and then prime myself up to redeploy some of these assets into longer lease land lease freehold assets. I think not only I will stop the NAV from the land lease decay problem from increasing, but at the same time I'm able to add back distributions to it. So yeah, so in short, yes, I think the question is a fair question. But I'm really realistic. The answer is yeah. I'm not buying insurance here to say I won't be able to sell premium. Answer is cost has gone up.
Sure. Okay. Related to that is also a question regarding costs. So as you have mentioned, costs have gone up possibly due to the weakening global economic environment as well as high interest rates. How would that impact the DPU for ELOG?
Okay. I think as far as possible, if you look at my results, I didn't have it here, a full slide rather than the full. But if you look at my full results announcement, the big cost is actually expenses, right? Utilities, as well as inflation costs on cleaning contracts, or what I call OPEX, cleaning contracts, security contracts, labor costs, or what I call OPEX costs. I think I've managed that part as far as possible. Utilities, we have passed through 90%. So and a lot of REITs this year. I mean, embedded in the my numbers obviously is that if you see NPI is, despite higher interest expenses, NPI is still up by 42% because there's a contribution from the ALOG portfolio. But the NPI increase would have been higher but it has been mitigated by higher interest costs, higher utilities costs. And you can all remember that first half of last year, fourth quarter of 22, 21, and first half of this year, the energy costs went haywire. You know, I can share with you the energy costs went like 4 or 5 times. A lot of us were naked. A lot, not just us. A lot of landlords were naked, and that is why it got hit badly in terms of operating costs. But as of now, 90% has been being passed through. 2023, we believe that we will not be that subjected to that big shock in terms of utilities expenses. Interest rate wise, as I said, 72% of our floating rates are being hedged. I give a little bit of guidance just now that we thought that we will have to, the interest cost will probably go up to about 4.1, 4.2% if we maintain a 66% hedge. We managed to hedge a bit more at 72% at good rates. So expected interest costs probably this year will be about 3.8% from the current 3.66%. It's because we hedge more, and that there's probably no refinancing risk because $230 million of loans is up for expiry in October. We have more than enough RCF, committed and drawn lines for us to draw down and repay this 230. So we will not be subjected to bankers' loan shark pricing, if that's what I can put it in layman's terms. Yeah.
Okay, have to be honest, I've never heard the word naked and loan sharks in a corporate connect before, but that's cool. All right, we have a question about the gearing level. So are you comfortable with the current gearing level of ESR Logos? So that said, obviously you had hedge and so on and so forth, but are the current gearing levels comfortable in your view? And do you have any plans to bring it down further?
Okay, in my view, I have been very consistent. I've always been by 42%, 42% since 2018 and even 2019. I showed people that despite the 42%, I am still able to service my debt. I can still able to bring down my margins on my loans. I can still able to access the bond market, etc. Run my business and not risk. But I can understand in the rising interest environment, I have investors, both retail, family office, and institutional investors tell me, Adrian, I prefer in such an environment for you to be on the right side of 40%. So I prefer to see a 3 than a 4. Even though, yes, you have done very well to making sure that you can refinance. The bankers do not hold you ransom in terms of pricing. Yes, but for me to sleep better at night, I would prefer you to have a 3, because if recession is coming, you don't know what is going to happen. The war doesn't end. Yeah, look, you may suddenly, I just want to have the surprise, even though right now they can't tell me what the surprises are. So yes, I have intention to actually bring that down. And also probably that's part of the reason why my share price is in a way kept in terms of increases. It's because if someone looks at 2 REITs and they say, oh, one is 41, on face value, one is 41, one is 39, why not you buy the 39 because you can sleep a bit better. So how do I then bring down the gearing? The intention is that when we divest assets, the sale proceeds will be used to pay down some of the debt. And at the same time, if that's extra, we'll redeploy in our AEIs, redevelopments and all.
Okay, good. Just now you had answered a question about the merger with A-REIT previously. So a slightly different take on the question would be during the merger process where you had to get approval from shareholders, there would have, there were projections on the synergies as well as possible economic windfall. Has that materialized and to what extent given the challenging environment?
Of course. If you look at my results right now, just look at interest costs. All right. The interest cost has gone up by line item that you will see in my line item, right? The interest cost has gone up by let's say, I think about 30% or whatever. It's not because the base rate has gone up. Okay, not because interest cost has gone up. It's because we took on a larger loan to take over, and that is why the amount, all right, is higher. But this larger amount was actually offset by the fact that our credit margins come down. Yes, base rate has gone up. Okay, base rate has gone up, no doubt. I mean, SORA has gone from the start of the year last year of like 1% to like 3% today, right? But at the same time, while the SORA, the base rate has gone up, which technically means that for the same dollar amount, you have to pay more, our credit margin has come down. We used to be over our credit margin, you know, it's like a housing loan, right? SORA plus 50 basis point, that's your credit margin. Our credit margin used to be 202.5%, 2.2 to 2.5% 3 years ago. Today, for the same amount, the credit margin is about 1.2%. So that drop at the credit margin has offset the increase in the base rate. Now, in a perfect world, I would not have wanted the base rate to go up by 2 times. Then I would actually see more, you actually see more credit savings. So the synergies has come from that. Now, at the same time, the rental reversions are also showing that in terms of our market. And also more importantly, because we are much larger, we are more on the radar screens of a lot of more the MNCs. We would not have gotten NTS Singapore, which is a major manufacturer, to come to us, sit down with us, and do a build to suit for 21 Senoko Loop if we had been a smallish REIT. MNCs also wants to make sure that when they go and do a redevelopment and do in the contract with someone, this person, the counterparty is someone that's large, sizable, and be able to deliver. Yeah. So that is where, and also at the same time, right now, why I'm able to tell the market in my results, I'm exploring analyzing a potential redevelopment of a cold store ramp-up facility. If you look at that slide just now, if you look at all my AEIs, we used to be only able to do AEIs and redevelopment in the $50 million to $30 to $50 million. That asset is now $200 million. If we had not had that size, we would not have the opportunity to speak to the operator, potential master lessee, to actually look at that. And they will probably go to the bigger boys, you know, and because they will say, hey, your AUM is so small. What makes you sure that this 200 million you can deliver? But today we're much larger. We have we have the ability to have the resources, both financially as well as human resources, right, and expertise to actually do a larger 200 million. Now, as we get larger, the size of the redevelopment acquisition to move the needle has to be larger, or else it just doesn't. Not the you know this question would be, hey, you do so much work, in the end it doesn't move the needle. You know, so by being a larger, we're able to attract, and because of we are also much larger, when we sit opposite now the MNC, we are able to have a bit more clout. We are no more just a price taker. We are more able to put up the stake and say, look, there are some terms which we do not disagree. For example, security deposit. We will enter security deposit with people who takes 15 years lease, 10-year lease. If we are not large enough, we don't have the clout, that guy will tell me, I would have signed a 10-year lease with you. I'm going to do 3 months security deposit. How can we sign a 10-year lease with a 3-month security deposit? We tell them our principle is every 1 year of lease that you sign, you need to have 1 more month of security deposit. So instead of 10 months, they wanted 3 months. If we're not been large enough, we won't have the ability to speak to these people and demand, I won't say demand, but they negotiate to get 10 to 12 months of security deposits.
Okay.
So this is where I see the synergies coming back. Not just on cost, but the ability to get more business, the ability to change our tenancy and bargaining power. Yeah.
Okay. All right. So we have run through the pre-submitted questions, and I think you have fielded most of the questions that we have online, actually. So time now is 4 minutes past 8. Thank you very much for joining us this evening, Adrian. I understand you're joining us from Hong Kong. How is it going?
Well, it's okay. I think a lot of investors just want to ask how is the performance how do we manage our downside risk? I mean, the two elephant in the room is still obviously utilities cost. I don't think the war is going to end anytime sooner. Energy prices will still stay high. Interest rates, even though it's plateauing, is still probably high. So the investors are asking us, how do you manage this? As what the unit holders today ask. I mean, how are you going to manage all these interest costs as well as utilities costs? And I hope that I'll be able to answer that. Yeah.
Okay. Well, thank you very much. I'm going to hand over the time to Eileen.
Thank you, Adrian and Benjamin, for insightful sharing tonight. I think we have come to the end of the session. In case you missed any part of today's session, you can rewatch the webinar at SIAS YouTube channel. I think Corporate Connect is a bi-monthly webinar. Do visit our website to get updates on the upcoming investor education programs and initiative. The upcoming Corporate Connect will be featuring OUE commercial REITs on the 21st February. Thank you for joining us tonight. Have a nice day.
Yeah, thank you.
Thanks, Adrian.
Thanks.
Thanks.